Welcome to Bloomberg Markets. I'm Katie Greifield. It is a big week for tech earnings, geopolitical uncertainties, top of the list for investors to start the week. Let's take a look at where markets are trading, of course. It is Monday of a consequential 10-day stretch. You can see the S&P 500 managing to find a rally here, up about 0.4%. Big tech, this is interesting, of course, clinging to gains here. It had been your pre-market leader, not anymore, but still up about 0.3%. We have all the heavyweights. Not quite all, but a lot of them reporting this week. A lot of focus on that AI spend, which we will talk about. You take a look at crude, of course, moving a little bit lower. Of course, Israel taking an attack at Iran, but relatively contained when it came to the infrastructure. Of course, crude moving lower as that risk premium gets priced out, currently trading just below $68 a barrel. And then you take a look at the yen, of course, dollar yen higher by about 0.6%. Meanwhile, let's take a look under the hood of the equity market and take a look at some midday movers on the equity side. And first up, fresh off Donald Trump's event at MSG this weekend, the trading of DJT is seeing major volume. You have to imagine a lot of that is retail traders, and the stock is soaring as a result, up 18%, now at its highest level since June. Let's move on. Let's talk about onsemi, because it's been up and down all morning, now currently hanging out in the green, solidly higher. The company reporting third quarter results that beat expectations. It also gave a forecast that came in at the high end, topping estimates. Of course, shareholders seem to like that one. Let's talk about what they're not so sure of, those shareholders, and that's Boeing launching its much awaited capital plans. It is conducting a nearly $19 billion share sale. That is one of the largest ever from a public company. And this, of course, as Boeing really seeks desperately to address its liquidity needs and stave off a potential credit rating downgrade to junk. And for more on Boeing right now, let's welcome in Julie Johnson. She covers aerospace for Bloomberg News. And Julie, there's a lot to dig into here. Let's first, of course, start with the fact that Boeing really trying to avoid that downgrade. Will this go far enough?
Yes, absolutely. In fact, this should shore up the company through its crisis, unless there's some other black swan that swoops in that nobody's seen. But this is really Boeing saying, here's what we need over the next couple of years. They've got some big debt payments coming up, about $12 billion worth. And they know they're going to lose money, or they're going to bleed cash next year as a result of the strike that's going on right now. So this is Boeing saying, we're putting our nest egg together. And we'll be really interested to see how it's received by the market, whether it's oversubscribed or not. And, there might be signs of Wall Street sort of calling the bottom on this stock.
Yeah, and I'm glad that you bring up demand, because this is the largest share sale, I believe, since 2020. So it's been quite some time since the market has had to take down this sort of size. But let's talk a little bit more about the strike, because I have to imagine pretty quickly after the share sale, when it comes to the Boeing priority list, is resolving the strike. And where are we on that?
Absolutely. It's grinding on. We're in the 7th week. And if you could believe it, this union has an average of being out for about 2 months when they go on strike. And the history dates back to the 1940s on that. So they're not afraid of, staring management in the eye and getting basically every last penny. And that's going on here. If you are in the Boeing camp, I think there's got to be some measure of good news in that the last strike, or the last vote last week, where, on Boeing's latest contract offer was voted down by 64% of the members, but that meant that 35% were on board with settling this. And that's a big change from September. So, it feels like gradually the two sides are getting to the place where something will be worked out. But yeah, that's a huge source of heartburn right now for Boeing.
Yeah, so still a lot of daylight. Maybe it's getting a little bit better, but plenty of wood to chop there. I do want to talk about what else Kelly Ortberg could do at this point. Of course, Bloomberg News has reported that Boeing is conducting a strategic overview of its different businesses. There's a lot of questions over what will become of the space unit, for example. What's the latest state of play?
Yeah, it's a little bit early on all of this. We've known that Starliner, which was the troubled craft that came back to Earth without its astronauts from the ISS last month. We've known that was something the company has been looking at and debating whether they want to put more money into that program, given the history of cost overruns. Um, with regards to the rest of the space assets, I think it's a little bit early. I mean, Kelly Ortberg said on the company's earnings call last week that he and his team are systematically going over its entire portfolio, which is huge, and looking for businesses that are underperforming or that might do better with other buyers to carve off. And they expect to have this wrapped up by the end of the year. So I think for the space business, there's some parts of it that would make sense for Boeing to hang on to. And so it feels just a little bit early. I don't think, the company's not out there marketing, these assets.
Well, we'll continue to keep an eye on that one. I know you're a busy woman, so I appreciate you taking the time today. That is Bloomberg's Julie Johnson covering aerospace for Bloomberg News. Absolutely a very busy beat. Let's stick with transports, though, because the slowdown in electric vehicle demand is playing a role in hurting some automakers on both sides of the Atlantic. We have Ford earnings due out this afternoon, where investors are watching for potential cost-cutting measures. But earlier today, we also learned that Volkswagen plans to close at least 3 factories, eliminate thousands of jobs, and also slash wages for tens of thousands of German workers. For more on all of this, we're joined now by Bloomberg's Detroit bureau chief, David Welch. And David Welch, I sit next to Matt Miller for at least 2 hours every single day. So starting with Volkswagen, I heard time and time again, this is huge. Put it into context for us.
It is really massive, and my condolences for sitting next to Matt for a couple of hours, but and I love the guy. Volkswagen is just underinvested in the main Volkswagen brand. It's really struggling in Europe, and that's always been a big moneymaker for them just because of the sheer volume of it. And lately they've struggled a lot in China, as all foreign automakers to the Chinese market are. That was a big moneymaker for them. And for a long time, they underinvested in the Volkswagen brand, in their mainstream cars, because they had profits coming in from Porsche, from Audi, luxury brands, and because China was such a cash cow for the company. All that's kind of coming home to roost now as China looks worse, and they have to sort of make a lot more of their profits with just the European business. That puts them in cost-cutting position now, actually racing to cut production and costs to improve profits in Europe. And that's where you're getting these ideas where they have to close plants, they have to cut wages. The union is the group that put this out there on the street. They say they're going to fight it. So as if they didn't have enough headaches with just fixing the operations of their business, the unions over there don't sound like they want to play ball. And there could be a lot of fighting over there, and it could be pretty ugly. So yes, this is massive because, look, I can't remember the last time Volkswagen, if they have, in the time I've been covering this beat, closed plants in Germany. And it's hard to overstate how important that is.
Yeah, painful for the German economy as well and the German workforce. Does it help at all when it comes to VW's case that it's not just a VW issue? I mean, you've seen profit warnings from Mercedes, from BMW in the past couple of weeks as well.
You have. Look, the European market right now is pretty tough, and it has been for a very long time. It's just not, it's not the kind of market like in the U.S. where you have big trucks and SUVs that command huge margins. You have some of that, but a lot of it is smaller vehicles that just aren't as profitable. And there's a lot of competition because Chinese companies have been pouring in there. The Koreans were before them, Hyundai and Kia, and they do pretty well taking market share. And then all of the European companies, every Italian and French brand, they're all fighting for market share there. So it's always been tough to get great pricing, and it's been a sort of a bargain price sort of market. And, Volkswagen, because of their sheer volume, was still able to make good money there because they get great scale. But, now, that's getting squeezed because there's greater competition, and the market itself is slumping a bit. The U.S. market's been pretty resilient, so the companies that do very well over here are at least able to hold their profits. But Volkswagen doesn't do much business over here, and the China business is shrinking. Right. So that puts a greater spotlight on the European business that they have because the other markets don't do so well.
And let's quickly talk about the U.S. We have less than a minute left, but I have to ask you about Ford, because you take a look at Ford shares. It's been a rough ride, especially since they last reported earnings in late July. What are you going to be keeping an eye out for after the bell today?
So look, in late July, they told us they lost $800 million because of quality and warranty issues. Does that improve? And they also told us that they expect to lose $5 billion this year on their electric vehicle program. Can they wring costs out of that to lower the damage from their EV program, and also just generally get their costs lower and show us a better profit?
All right, David, always great to speak with you. Appreciate, of course, the preview for Ford earnings coming later today. That is Bloomberg's Detroit Bureau Chief, David Welch. Now, coming up, it's our stock of the hour, and we're taking a closer look at a big player in the fintech space. The CEO of Fiserv is joining us live from the Money 2020 conference in Las Vegas next. This is Bloomberg. Welcome back to Bloomberg Markets. I'm Katie Greifield, and it's time now for our stock of the hour. And today we're taking a look at Fiserv. The shares higher in the session. Of course, the payments company is at the Money 2020 conference in Los Angeles on the heels of some major announcements. The event calls itself the world's biggest gathering of the global money ecosystem. And I'm pleased to say we're joined now by the CEO, Frank Bisignano. And Frank, it's great to have you with us, of course. Fiserv recently reported earnings. You've seen a number of price target upgrades from the sell side in the past couple days or so. Talk to us through what is your biggest growth driver at the moment and how you see that playing out over the next couple quarters.
Well, I think it's a multifaceted approach here. Obviously, we're indexed to financial services and to businesses. Our ability to help small businesses grow and help financial services grow. You see a product like Clover, which I actually launched here in 2015, unveiled it. We worked on it since 2013, is now a 28% revenue grower and been in market and has the most GPV out there. So obviously serving small businesses matter, but serving financial institutions and helping them drive their growth and being a large technology partner of theirs is all part of our ecosystem.
And let's talk a little bit about the competitive landscape here, because I'm curious who you consider your competitors. Are you an alternative to Visa, to MasterCard, or should I be thinking about you in a different way?
Well, we're a commerce enabler, so obviously we process all types of payments, and we view ourselves as an enabler for both issuers and for businesses. The ability to do 40% of credit card payments across the U.S. Gives us the opportunity to be ubiquitous to all providers. We view ourselves always as a partner. We believe we're the distribution partner of choice to many. So anywhere in the ecosystem, we want to partner with people. Obviously, we like competition. We believe in competition. We think competition is good. We think it's made us perform better. And we have lots of competitors out there, and many of our competitors are partners also.
I'm curious if you're worried about regulation here. You think about the regulatory scrutiny around the different card networks right now. The DOJ has an antitrust lawsuit against Visa. Does that keep you up at night?
Well, I generally sleep good regardless. We have a point of view that regulation's forever, and it's been forever. So, having spent my long career in financial institutions and now serving all the financial institutions inside this country and outside the country, I think regulation's normal. I think, it's required. We can always debate where the line gets drawn. But generally, we get the right answer, whether it's what's going on right now at the DOJ or what's gone on before. It's really as the consumer's interest as best art. And our job is to help enable payments for everyone on any rail we can.
Well, let's talk about some recent announcements in the payment space that you've made. You've tested a real-time payment service offering with Walmart, for example. That should allow customers to transfer funds from their bank accounts to online purchases. How quickly do you see these account-to-account offerings actually being taken up in the U.S.?
Well, I think they're going to be taken up. I think that our view is our job is to provide the best possible rails for any form of commerce. And, we sit as a great partner of Walmart's. If they want to enable pay by bank, we have the rails to do it. We have the capability to do it. Then it'll be consumer adoption. But, some consumers may want to pay by bank. Others may want to pay with Zelle. Others may want to pay with the card in their pocket, whether it's a retail private label card or whether it's a MasterCard or Visa. Our job is to enable it no matter what. And I think we're continually seeing consumers wanting choice. And we want to give both the consumer and the merchant all the choice they want.
All right, Frank, really quickly here, I am curious, given that you have this unique perch, of course, what are you seeing when it comes to consumer spending ahead of the holidays, ahead of the election?
Well, we produced the Fiserv Small Business Index, and we started that with the idea that we wanted to be the heartbeat and the pulse of what was going on in small businesses. We see spending really kind of consistent through September, October. I think the holiday season has gotten elongated, so it's not what it used to be even 5 years ago. There will be a question what holiday season is, but the consumer's been out strong. It continues to grow spending, and I'm continuing to be bullish on the economy.
All right, well, that's a good place to leave it. Frank, really appreciate your time. That is Fiserv President and CEO Frank Bisignano. Meanwhile, coming up, we're going to take a look at growing concerns around U.S. fiscal spending and how the bond market might react as we approach the U.S. election. And earlier today, JPMorgan CEO Jamie Dimon mentioned this spending and other issues at the American Bankers Association.
Inflation, in my view, may not go away so quickly, okay? And so you might go into next year, 2026, where it starts ticking up a little bit like it did in the 70s. Huge fiscal spending. The remilitarization of the world, which is inflationary. Demographics is inflationary. The green economy is inflationary. The restructuring of trade is inflationary. So I see a lot of inflationary things in front of us.
Welcome back to Bloomberg Markets. I'm Katie Greifield. And the Wall Street veteran who coined the term bond vigilantes in the 1980s, his name is Ed Yardeni, and he says the approaching U.S. election could see them return. This comes, of course, as the U.S. Treasury readies its refunding announcement. Yardeni spoke today on Bloomberg Surveillance.
If we get a sweep, either the Democrats or the Republicans, the bond market will conclude that nothing will stop either party from spending a lot, maybe cutting taxes a lot for some folks, not for others, and all in all, continuing to widen the deficit and the debt. Meanwhile, the interest payments continue to accumulate and will probably hit $1 trillion.
Let's keep the conversation going now with Ira Jersey with Bloomberg Intelligence. Ira, it's great to have you with me. Are the bond vigilantes coming back? Should I be scared?
I think they've already, in a way, come back. We hear more and more about the level of debt being a real issue. When Ed first came out with those comments, the U.S. debt to GDP was, under 30%, and now it's over 100, right? So, if the bond vigilantes didn't like 30%, certainly they don't like 100%. I really think the way to think about the level of debt and then how the bond market will move is that the larger the debt stock is, the deeper the sell-offs will be, and then the shallower the rallies. But it's still, day to day, it's still going to be the economic environment and what the Fed does about that's going to ultimately move the market the most.
Let's talk a little bit about those sell-offs, because we've been seeing quite a sell-off when it comes to the long end of the Treasury market. You take a look at 10-year yields, they're up 60 to 70 basis points since the Fed cut rates in September. What do you make of this sell-off? What is the actual driver here, and how far could it go?
Well, certainly the economic data is by far the biggest driver of this. The Fed cut interest rates 50 basis points. People thought, oh, maybe that will help the economy in the long term. But then all of a sudden you get a good payrolls report, a higher than expected CPI report, plus a better than expected retail sales report. All of those things combined really suggest that the economy continues to be in relatively good shape. And so therefore, there's not a reason to think that the Federal Reserve is going to be able to cut interest rates all the way down to 3% or below, which is what we were pricing right before the Federal Reserve cut interest rates. So it's still the economy is the single biggest thing that matters. And unless we get a significant slowdown and a turn in economic data over the next couple of months, then I suspect that we'll wind up finding a ceiling on 10-year yields, call it 4.5% plus or minus 25 basis points that we end up staying in for quite some time until it's clear that we either have a reacceleration of economic activity or a massive slowdown and toward a recession.
All right, well, we're currently camped out at about 4.28%, so pretty much in that range. So, Ira, that's a good place to leave it. Really appreciate your time. That, of course, is Ira Jersey with Bloomberg Intelligence. A quick check on these markets. Volumes a little bit lower when it comes to the trading right now. Of course, we have a hefty week of event risk. Not too much happening today, and you can see that reflected in the trading volumes, maybe in a little bit of wait and see mode. We'll continue to monitor that throughout the U.S. day, but that does it for Bloomberg Markets. I'm Katie Greifield, and this is Bloomberg.